The strange thing about debt is that everyone agrees it's dangerous right up until the moment they need it. A government borrows too much. The numbers stop making sense. Interest piles on top of interest. Economists start using words like unsustainable. Politicians promise discipline. Markets get nervous. And then they borrow more. Not because they want to, because they have to. This is the part that doesn't get explained clearly. Countries don't just fall into debt traps by accident. They often see it coming. They know how it ends. History has shown them over and over again. And yet they keep walking in the same direction. So the real question isn't why do countries borrow? It's why can't they stop? Right now, global government debt is sitting at levels we've never seen in peacetime. Trillions upon trillions of dollars. Numbers so large they stop feeling real. The United States alone has crossed $30 trillion. Japan is over 250% debt to GDP. Even smaller economies are carrying loads that would have been considered catastrophic just a few decades ago. And yet, instead of slowing down, borrowing is accelerating. If this were a household, we'd call it reckless. If it were a company, investors would panic. But when it's a country, the rules seem different. To understand why, you have to zoom out and look at what government debt actually is. Because it's not just borrowing. It's the foundation of the entire financial system. When a government borrows, it issues bonds. On the surface, a bond is simple. The government takes money today and promises to pay it back later with interest. But those bonds don't just sit in a vault somewhere. They become the safest asset in the system. Banks hold them. Pension funds depend on them. Insurance companies rely on them. Even other governments buy them. They're used as collateral, as benchmarks, as the risk-free rate that everything else is priced against. In other words, government debt isn't just a liability, it's also everyone else's asset. And that creates a strange dependency. If government suddenly stopped borrowing, the world wouldn't stabilize, it would break. There wouldn't be enough safe assets for the system to function. Banks would scramble, interest rates would behave unpredictably, entire markets would lose their foundation. So already we have a paradox. Debt is dangerous, but the system needs it to survive. Now add growth into the picture. Modern economies are built on expansion. More production, more consumption, more investment. Growth isn't optional, it's expected. It's baked into everything from stock markets to employment policies. And growth often requires spending. Infrastructure, healthcare, defense, social programs, crisis response. These aren't small line items, they're massive, ongoing commitments. Taxes alone rarely cover them, especially in large economies where political pressure keeps tax increases unpopular and spending cuts even more so. So, governments fill the gap the easiest way possible. They borrow. At first, it seems manageable. Borrow a little, grow the economy, use that growth to handle the debt. Repeat. But here's where the math starts to shift. Debt grows faster than people expect. Because of interest. Every dollar borrowed doesn't just need to be repaid, it needs to be repaid with extra. And when new borrowing is used to cover old obligations, the system starts feeding on itself. This is where people imagine a clear breaking point. A moment when a country says, enough. But that moment rarely comes voluntarily. Because stopping borrowing doesn't just reduce debt. It triggers consequences immediately. Imagine a government trying to balance its budget overnight. Spending gets cut. Taxes rise. Programs shrink. Jobs disappear. Growth slows. Sometimes it reverses entirely. And when growth slows, the debt problem gets worse, not better. Because the key number isn't just how much debt exists. It's debt relative to the size of the economy. If the economy shrinks while debt stays the same, the burden increases. So, governments face a brutal trade-off. Keep borrowing and risk long-term instability, or stop borrowing and trigger short-term pain that can spiral into something worse. Politically, that's not even a real choice. Short-term pain is visible, immediate. Voters feel it. Elections respond to it. Long-term risk is abstract. It can be delayed, managed, explained away. So the system leans in one direction. Borrow now, deal with it later. But there's another layer to this that makes the trap even tighter. Interest rates. For years, decades really, interest rates have been falling across much of the world. That made borrowing cheaper, sometimes incredibly cheap. In some cases, governments were effectively borrowing at near zero cost, even negative rates in certain markets.
Which creates a dangerous illusion. If borrowing is cheap, why not borrow more? If the cost of servicing debt stays low, even large debt levels feel manageable. So countries expanded their borrowing not just out of necessity, but because it seemed rational. And for a while, it worked, until rates started to rise again. Now the same debt that once felt harmless begins to feel heavy. Interest payments grow, budgets tighten, the margin for error shrinks, and suddenly reducing debt becomes even harder, because cutting back now would mean doing it in a higher rate environment where the impact is more severe. So instead of slowing down, many governments double down. They refinance, roll over existing debt, issue new bonds to cover old ones. From the outside, it can look like denial, but from the inside, it feels like survival. There's also a psychological component that rarely gets talked about. Debt at a national level doesn't feel real in the same way personal debt does. No single person is responsible. There's no final bill that arrives in the mail. The timeline stretches across decades, even generations, which makes it easier to justify. A little more borrowing for a crisis, a little more for growth, a little more for stability. Each decision makes sense on its own, but collectively they build something much harder to control. And history shows what happens when the system finally reaches its limits. Sometimes it's inflation. Governments, directly or indirectly, increase the money supply to ease the burden of debt. The value of money declines, prices rise, the debt becomes easier to repay in real terms, but at the cost of purchasing power.
Sometimes it's austerity, spending cuts, tax increases, economic contraction, social tension, a slow, grinding attempt to regain control. Sometimes it's default, the most dramatic outcome. A country simply cannot meet its obligations and restructures or fails to pay. None of these outcomes are clean. None of them are painless. And importantly, none of them are guaranteed to happen in a predictable way. Because large economies, especially those with strong currencies, have more flexibility. They can delay, adjust, shift the burden in subtle ways. Which is why the end rarely looks like a sudden collapse. It looks like a long, uneven adjustment. Now, here's where it gets uncomfortable. A lot of what people believe about government debt is based on the idea that there's a clear limit, a point where everything breaks. But in reality, that limit is flexible. Countries have operated at debt levels that once seemed impossible. They've sustained them for years, sometimes decades, because as long as investors believe the system holds, they keep buying the debt. And as long as they keep buying, the system keeps going. So the real constraint isn't just math, it's confidence. Confidence that the government can manage its obligations. Confidence that the currency will hold value. Confidence that the system, even if strained, won't snap. And confidence is a strange thing.
It doesn't fade gradually. It can shift suddenly. Which brings us back to the original question. Why can't countries stop borrowing? Because the system they operate in rewards it. Because stopping creates immediate pain.
Because the debt itself has become essential to how the financial world functions. And because as long as confidence holds, there's no clear signal to stop. It's not ignorance. It's not necessarily recklessness. It's a structure that pushes decisions in one direction over and over again. Borrow, stabilize, delay, repeat, until something forces a change, and that something is rarely predictable. It could be inflation that refuses to come down. It could be interest rates that stay higher than expected. It could be a loss of trust in a currency, or something entirely different that no one sees coming. That's the unsettling part. Not that countries are borrowing too much, but that they might not have a clean way to stop, even if they wanted to. Because in a system built on debt, restraint isn't just difficult, it's disruptive. So the cycle continues, quietly, rationally, inevitably. And the question that lingers isn't when countries will stop borrowing. It's what finally forces them to.